Today let's explain the difference between an endowment policy and a term policy as far as life insurance is concerned. Let's first explain a term plan for a life insurance policy. In a term plan, what happens is you pay a fixed amount of premium, and on death of the policy holder, the nominee gets the amount insured. In short, you keep paying, and if you've paid, the policy holder expires anytime during the period of the policy, the nominee gets the entire sum that has been insured. If the policy holder stays alive throughout the term, for example, if a 40-year-old has a 20-year-old life policy and he turns 62, his policy has expired, but the amount of premium that he has paid does not come back to him, which means the amount invested is not returned. But in these 20 years, between 40 and 60, if he passes away, the nominee receives the sum insured. Now, in the case of an endowment policy, it's just the opposite. In case a person remains alive, that means let's say a person is 40 years old and he takes a 20-year policy, which means even at 60 years, if the policy holder stays alive, he receives the amount that he's paid by way of premium. So that really depends on the bonus and other things. So in term policy, if the person stays alive and the insurance has completed the term, he does not receive any benefit. But during those 20 years, if he passes away, he gets a very, very high insurance amount as compared to the endowment policy. In the endowment policy, you don't get a high amount simply because you're going to get the money back in case you stay alive after the completion of, say, as an example, 20 years. So this is the basic difference. The other difference is in the term insurance plan, the insurance amount is very high. Typically for a non-smoker who's aged 30 years, you could get a 1 crore policy in a premium of 8, 9, 10, 11,000. But to get a 1 crore policy under an endowment policy, you would have to pay a very, very high premium, simply because if you remain alive or the policyholder remains alive, he gets it back after that specified period. So the insured amount is not really high. There are two things here. If you're looking for pure insurance, you should go for a term insurance plan and not an endowment policy. We suggest that endowment policy, though you get the money back in case the policy holder does not pass during the term of the policy, the amount insured is very, very less. In this case, you are not securing your family adequately, so you at all times need to take a term insurance policy. A term insurance policy that is high in amount, which secures your family and the future of your children. So if you're looking for investment that also includes life insurance cover, endowment policy is all right. But if you're looking at a pure insurance plan, then you must go for a term insurance plan. If you ask us, we would prefer going for a term insurance plan. If you want to invest as well as get a life cover, we suggest you do it separately. You take an investment elsewhere, because the returns on an endowment policy are not very high. So if you want a mix of investment as well as insurance, why take an endowment policy? You can go for investment separately and an insurance, which is a term policy, very separately. So both a term insurance plan and an endowment policy both give you tax benefits under section 80C of the Income Tax Act. What this means is that if you invest up to 1.5 lakh, the amount is deductible from your total income for determining your tax liability. So you can take avail section 80C benefits for both the endowment policy as well as the term insurance plan. As suggested, we strongly recommend that you stick to term insurance plan, because that's always a better proposition.